Okay, so I'm gonna go over the different types of life insurance policies today. As you guys can see right there, it says Gladys entered the waiting room, just hit admit, and that's fine. Cool. So different types of life insurance policies. There are mainly two types of insurance. Okay, and I'm gonna create a whiteboard for this. You guys are gonna see on my screen here. And then this will be available after the meeting for you guys to have. Just send me your email. And anybody watching this video on YouTube, I'm actually going to make a Google Doc out of it. Anybody watching this video on YouTube, just email me for this and I will send you, or email me at my email's in the description of the video. It's jve@thejve.com. All you got to do is email me and I'll provide you with this life insurance policy study guide. Okay, life insurance policy types. So on most of the exams, on most of the final exams, what I've seen, people usually get tripped up on the types of policies or the options, riders, and provisions and all that stuff, the riders. So today we're going to cover the types of life insurance. Now, I'm going to share my screen here. It's mainly divided up into two sections. So it's mainly divided into term life and then permanent life insurance. So term life and permanent life. I'm going to make this a little bigger. Okay. Term and permanent. All right. Term life is temporary. So an easy way to remember this is term terminates. Okay. Term terminates at some point. So it's temporary. Permanent life insurance lasts your whole life. It typically lasts until age 100. At which point the policy endows. So when it endows, that means that you will receive whatever the face amount of the policy is if you haven't died. So it's like a permanent savings account, or it becomes an immediate legacy, an immediate estate. Does that make sense, guys? So if you're like, I wanted to get a $100,000 whole life policy, the company says, okay, well, we're going to guarantee that you save up $100,000 by the age of 100. And if you don't make it to 100, we'll give your family the $100,000. Does that make sense? Any questions about that? Okay. I'm going to try to break this down into simple terms. The tough thing about these courses, and it's really the state's fault, so you can thank the state governments for being amazing for this, but what happens is they tell the companies, because I'm working on this now, they tell companies that you have to have 20 hours worth of study material in the course. This stuff can be broken down in a lot less than 20 hours of study material. But the problem is that it has to have a certain word count. So you notice how sometimes they're really wordy, like the courses, it just there's a lot of fluff in there. That's because the states require that it has to have a certain amount of words. So if you look at we'll just do a quick math here. This is to help you guys understand why the courses might not be as simple as we may want them to be. And if you watch some of my videos, they may help. You can subscribe to the channel, turn on post notifications. If you're watching this on YouTube, I'll give you guys all my YouTube link. Once again, if you want the study guide, just email me. My email is going to be in the description of the video. But the average person reads 100 words, right? So 100 words, that's like average, like standardized, whatever. That's like what companies go by, 100 words a minute. So if it's 100 words a minute times 60 minutes in an hour, that's 6,000 words the person can read in an hour. And if it's a 20-hour course, that's 120,000 words that needs to be in there, right? Some states have a 30-hour course, which would mean 180,000 words. Colorado has a 50-hour course, which means ridiculous amounts of words, okay? So that's like 300,000 words or something crazy. So think about it. Like they have to make them these like long explanations. So there's a lot of tools you can use. You can use ChatGPT to help you too if you guys haven't used that yet. But I'm gonna break it down, try to break it down a little more simple here. So term life is temporary. So term terminates. Okay. It's not the Terminator, but it's a ChatGPT reference. It's funny, you guys know how in Terminator they called it Skynet, I think was the name of the company. So I got Starlink where I am now, and I rent my house, and my landlord was like, oh, I asked him to get Starlink because I live in Puerto Rico. It's just a little easier for when storms come. And I was like, hey, did you get the internet thing ordered? He's like, oh yeah. He's like, I got the Skynet thing. He didn't even realize that he forgot that was the name of the company, Terminator. I don't know, I thought it was fun. So term terminates. Now there's a few types of term. So there's level term, decreasing term, and increasing term. Okay, so term, it can be based on the death benefit. Level term, increasing term, and decreasing term. So level term is the same death benefit through the entire and through the policy duration. Decreasing term is decreasing death benefit. Increasing term is increasing death benefit. So let me see if I can put this on a little chart for you here. If I can draw something. Tools, is there a way to draw on, I forgot, is there insert drawing? Here we go, new. Okay, so if we have, say this is the x-axis or y-axis, and then we get the x-axis here for all you math people who love math so much. We got that, and now we're going to where can we go to draw? Is that a curve? No. Okay, I don't want that. No. Stop. Okay. So essentially how it works with a decreasing term or a level term, the death benefit is the same. So if this is death benefit, and then this is years. Okay, in a level term, the death benefit is the same throughout the entire duration of the policy. So say this is 20 years. Say this marks year 20 right here. If it's a 20-year level term. Does that make sense to you guys? Typically, term insurance is used to cover something like a debt or replace someone's income. So imagine someone just has a baby and they're like, okay, well, I want to make sure that for the next 20 years, if I die, I can leave behind some money to my kid. Okay. So, or it's if you owe money on something. So level term can be used to cover a debt. Decreasing term is another one that's used to cover a debt. This is covered in the course law, but no one really gets these because the price between decreasing term and level term, it just doesn't, I don't know. I've never seen anybody buy a decreasing term, but they talk about it in the course, so we're going to talk about it here. Decreasing term is when the death benefit decreases over time. So it starts high and then every year it decreases. This is because this was designed to cover things like mortgages, right? Where over time you're paying
less.
You're paying less, yeah. So as you pay into the policy into your mortgage, the amount you owe the bank is dropping. So they structure it so that the amount of life insurance that you have drops in accordance with the amount that your mortgage is dropping. Does that make sense, guys? Any questions about level term so far or decreasing term? Okay. What premiums do you think are cheaper, level term or decreasing? Yeah, decreasing. So I've already pointed down, decreasing. Decreasing terms cheaper because the death benefit overall is lower. Right? Because in year 20, you're still paying for this big death benefit here. Whereas in here, year 20, the policy, I mean, it's pretty much nothing, right? Okay, now the next one is increasing term, which the death benefit increases over time. All right, so I'm just gonna put level, decreasing, increasing right here. Okay, you're not gonna, you're 99% chance not gonna see anything about increasing term on your policy. Another reason someone can get term is to cover business, to cover a business liability. So we're gonna bring this up here a little bit. So we're gonna look at uses for term. Cover debts, like a mortgage. Human life value. So you guys are gonna learn about that. Human life value is how much you're worth to your family.
Oh, boy.
How much you're worth to your family. So it's essentially like your income over the next, however many years. What's your value to your family over the next 20 years? They factor in how much you make plus inflation, raises, stuff like that. Make sense? Okay. It's also used for business, key person insurance or business funding, like buy-sell agreements. So key person insurance, say Tabby here was my CFO. And Tabby was a executive at my company, and she, she's very important to the day-to-day operations of the company. So if Tabby passed away, I would be in a situation where her job wouldn't be done. It wouldn't be being performed. So I'd lose money from that. And I'd have to find a way to recruit, hire, and train someone like Tabby. So there's a cost to that. And then there's a cost to the lost revenue from Tabby's absence. So key person insurance is essentially, I'd get life insurance on Tabby so that if she passed, I wouldn't lose any money from her dying, right? You guys get that?
Yeah.
Okay. Business funding or buy-sell agreements. Say Tabby and I both, say she was the CFO and I was whatever, and we both had a piece in the, say we had the company's 50-50. Say we split it 50-50. And the company was worth $1 million. Tabby would get $500,000 in life insurance on my life, and I would get $500,000 of life insurance on Tabby's life. That way, if I die, my family wouldn't get the company. It would be written that Tabby would buy out my portion and get it. That way, Tabby wouldn't have to do business and deal with my family who has no idea about our business at all. Makes sense. A lot of people do that in businesses so that they're like, hey, sure your wife's awesome, but if you die, I don't want to deal with her in the business aspect. She has no idea what's going on, right? So yeah, so we do it so that people do that so that they'd be able to buy that. Does that make sense, guys? For the business funding aspect of term? Okay. I'm trying to think if there's any other uses for term insurance. Let me just check see if there's anything I missed. Pretty sure it's got, oh yeah, income replacement. So we covered that. That's the human life value. Another thing is business protection, temporary coverage for specific needs. So whenever anybody needs essentially temporary coverage for a specific need, then that's where they get term. Okay, so next we're going to go with the duration of the term. So there is annual renewable term, ART, but we'll do annual renewable term. So annual renewable term is the cheapest form of pure insurance you can get. So essentially it's one price 1 year, another price the next year. It goes up a little bit more the next year and it renews automatically. Okay, guys? So what we're going to look at in another drawing here. Let me make this a little smaller. I'm going to put another drawing in here about the price of term, okay? The different prices. So we'll go here again. That'll be price over time. All right. So annual renewable term is gonna look like this. Year one, it's this price. And then year two, it's gonna go up a little bit and be this price. And then year three, it's gonna go up a little bit and be this price. And then year four, it's gonna go up a little bit and be this price, and it moves up like a staircase. Does that make sense, everybody? Annual renewable term. That's not artwork, that's annual renewable term. Okay, now. If you have a 20-year term or something like that, then it'll be level for the entire time of the term. So level term, the premiums are level through the whole term, because it's what it'll do is it'll average the price of the term out over that duration. So say you got a 20-year term policy. It's going to be more expensive than an annual renewable term would be right now, but it'll be cheaper than it would be in 20 years. Does that make sense, guys? Because it averages out the payment. So in an annual renewable, it increases a little every year. Level term is the same. So say if it was level, it's going to be in the middle here. Because at first, the annual renewable is cheaper, but then it gets more expensive as it averages it out. So say for these 5 years, you've got a 5-year level term instead of annual renewable, it would be the price would be leveled out like that. Does that make sense? For like a 20-year term, a 5-year term. So the term duration, the premiums are always level through the duration of the term. What can change is what we just covered, which is the death benefit, if the death benefit increases or decreases. Okay. So term insurance has no cash value. So term insurance has no cash value. There's no savings component. So no cash value savings component. Now term can be renewable and or convertible. So renewable means that the company lets you renew the policy at the end of the duration of the term. So if it's this one down here, say it's an annual renewable term, every year it's going to go up in price. If you've got a 20-year renewable term, it's going to be the same price for 20 years, and then it will go up in price when it renews after 20 years. Does that make sense? Any questions about that? Okay. So renewable term just means the company says, yes, you can keep insurance. They say you can keep insurance, but it's going to cost you more money. Next one, convertible term. Okay, this is not a drop top term. This is convertible term in terms of you can convert it from a term life to a whole life policy. All right. So the company says, yep, you got a term policy. If at any point you want to convert this to a whole life policy, you can without having to go through underwriting again and prove insurability. Same with renewable. They can renew the term without having to prove insurability. So they get the term the first time around, they go through underwriting, they get approved. And then, oop, my hand raised. And then it's renewable, it automatically renews without doing that. And then convertible, they can convert it without having to go through underwriting. They can turn it into a whole life policy. Term insurance is always cheaper than whole life for the same benefit amount. Because think about it, term is not a guaranteed payout. Like if you get approved for a term, there's like a 98% chance you're never going to file that claim, which is a good thing. You want life insurance to be the worst investment of your life. Because it means you want the lowest ROI possible on that life insurance, because it means you lived a long time, right? If you have a high return on your investment for life insurance, you didn't live too long. So we're hoping that, and when clients always bring that up to me, like, well, what if I pay in more than I get out? I'm like, then you lived a long time. That's good. That's a good thing. Well, you want to do that. That's the goal. So, by the way, guys, real quick sales tip for when you guys get started selling. Life insurance is something where, so any insurance protects someone against the risk, right? It's a transfer of risk. People are going to say, well, I could save up that money to pay for that stuff. And I could save up money for that. The thing is, can you afford to die, can your family afford for you to die today? That's what life insurance covers. It's not, hey, in 20 years from now, will they be able to afford it? It's, today, can your family afford to take care of the expenses that will come up from you passing? Alright. Because people try to always be mathematicians. They're like, well, if I save $37.27 every 2 weeks for the next 30 years. Like, Miss Jones, you're 60. You are not going to start saving money now, I promise. Okay? You've had plenty of time to start to get those saving habits going. I'm here to help you. All right. So yeah, term insurance, that's basically what term is. Any questions about term? Okay. Next, we're going to get into permanent life insurance. So typically it's called whole life. All right. I'm just going to be kind of rambling some stuff off here. So I got a hair in my mouth. So whole life lasts until age 100, at which point the policy endows. There are premium. The premium is how much money you spend on your policy every month. Okay. An insurance premium is how much money you spend every month on your policy. Real quick study tip here. It's hard to there's a lot of intertwining concepts in life insurance. So it's hard for the course to structure a way for you to learn the basics as it moves up, right? It's like you learn addition before multiplication, and the multiplication before you learn, calculus. So for the course though, it's really hard because everything's like the words are all intertwined with each other. So if you're reading something you don't know what a word means, please look up the definition. You'll probably learn about it later on in the course, but you just want to look up the definition. If there's a word you see you don't know, very important, because if not, you're gonna be lost. So please take that time. So premium payment, premium payment. So you can have it be paid to age 100. You can do limited pay, which is 10 pay, 20 pay. I'm gonna explain this in a second, etc. Or paid up at age X, which is paid 65 is most common. It's retirement age, and then you can do simple premium. All right, and then we have variable, and then fixed. So premium payment paid to age 100 or unlimited. So this is like, say I'm 34. If I got a whole life now and it was ordinary whole life, traditional whole life, then I will make premium payments every month or every year, whichever I want, up until till I reach age 100. Okay, makes sense. I'm also going to put participating. Okay. Limited pay is 10 pay. So say I'm like, okay, this is how many years they're going to pay it for. So if I'm like, okay, I want to pay this for 10 years and then be done. I don't want to make any more premium payments at 44 years old. That's called a 10 pay. 20 pay would mean I pay for 20 years, whatever. Now, if I pay for 10 years, obviously my premium every year is going to be more expensive than if I pay till age 100, right? Because it's spaced out over 10 years instead of 66 years. But overall, in 10 years, I'd pay a lot less in the 10 pay total than I would pay if I paid an ordinary traditional whole life for the whole duration until I was age 100. Is anybody confused on what I mean by that? So I'll just recap. Say I pay, in over 66 years, I pay you know, $66,000, $1,000 a year in an ordinary whole life. They may want me to pay $4,000 a year in a 10-pay whole life, but in 10 years, I'm only gonna have paid 40 grand. Whereas if I paid to the age 100, I'm gonna have paid in 66 for the same amount of insurance. So it's more expensive every year, but it's cheaper in total because the company doesn't have to pay as much in administrative costs and they get your money faster. So insurance companies take your money and then they invest it and they earn interest on that money that you paid them. Does that make sense? So if I give them all that money up front, then they have more money to make more money with over a longer period of time. So it makes it cheaper for me, total overall. Okay, that's how insurance companies have so much money, because they just get everyone's premium payments, they invest it into stuff, and then they pay claims with the interest usually, and then they just keep the rest of the money. Okay, and then there's paid up at age whatever. So a lot of people will do a paid up at age 65. So that means, hey, when I retire at age 65, I don't want to have to make any more payments on my life insurance. All right. And then there's single premium, which is just a one lump sum payment. So they just give the insurance company, you give the insurance company a big chunk of money, and then you have permanent life insurance. So say that $100,000, maybe for me it would cost $35,000. So I give them $35,000, and now I have $100,000 whole life that's permanent. Okay. Any questions about that? All right. And if I go over any words that you're not sure of, please let me know and I'll clarify them. All right. Thank you. Okay. Now we're going to cover variable versus fixed. So variable is variable whole life. All the others are fixed. Whoa. Okay. Variable whole life. So this is when your money, your premiums are invested in a secondary account. They are invested in mutual funds, in stocks. So what this does, this lets your cash value accumulate in proportion to the stock market and to funds that they're invested in. So you pay in your cash value. You know how I told you the insurance company takes your premiums and they invest it in stuff? Well, when you have a variable holding, you actually take your premiums and they're invested into something else. They're invested into stocks and bonds, or typically mutual funds, a mutual fund. So it's invested in the mutual fund, and then as that mutual fund earns interest, the cash value grows as well. So you're going to get higher. It's obviously riskier because it could, year to year decrease or whatever. But over time, if someone has a long time horizon for having the insurance, they're going to make more money in a variable than they will in a fixed account. Okay. Now, the fixed whole life is invested in the company's main account, or they call it general account. So these are less aggressive investments that the insurance company invests people's premiums in. Okay. So these are typically, I don't know, there's a bunch of different types of investments that they'll put their money in, but it's nothing risk. It's very, very safe to where the chances of loss are very low. Now the gains aren't as high, but the chances of loss are a lot lower. Any questions about that? Okay, so next we're going to cover participating versus non-participating. So participating means they're participating in receiving dividends. So these are essentially return of unused premiums. So, and then there are dividend options. So in a participating policy, it's done through a mutual company. So a mutual insurance company is a company that's owned by the policyholders. So when you pay your premiums, essentially you are paying in to help provide a piece of funding for that company's growth. Make sense? So you actually you are a part owner of the company as a holder of a policy with a mutual company. As that company earns profits, those profits are called dividends, and they're returned back to you into your cash value. Well, there's different things you can do with them. Typically, they go to purchase more insurance, which will increase the cash value. We'll cover that in a second. But what it is the company, these have special tax status because the life insurance companies, instead of saying, hey, this is a profit on your money that we're giving back to you, they say we're giving you back some of your premiums that we didn't end up using. Because they'll assess, they'll say, hey, based on the risk and the loss and the gains and everything else, we think that you're going to need to pay $100 a month, or say $1,000 a year. Say at the end of the year, they come back, they're going to say, you know what, our math was wrong. You only needed to pay $920, not $1,000. We're going to you have $80 of unused premiums that you're going to get back. So that's how they're able to get away with some tax situations there, tax breaks, because then it's not technically, they're not calling it a profit. Now, there are some dividend options. You can just get them in cash, so the company can send them to you in cash. Okay. It can purchase term. So essentially it'll purchase like a 1-year term policy that just extend however much term insurance that buys. That's how much it increases your policy death benefit for the year. Okay. There's paid up additions, which is that's the most common one. Paid up additions is they say, hey, here's $80 back. And then the policyholder says, okay, well, I'm going to buy $80 more of life insurance, just increase my policy right now, but by whatever $80 would get me for a single premium paid up insurance piece. You know how we just talked about single premium before? So say you're paying monthly on a $100,000 policy, and at the end of the year, they say, hey, you have $80 in dividends. You say, okay, instead of giving me the $80, just buy more life insurance with it and increase my policy to like $100,120. And then it accumulates, the snowball effect, because now you have a $100,120 policy earning dividends instead of a $100,000 policy. And it just increases over year, and it's like accumulation. It's like a snowball effect. And the policy increases, and then the cash value starts increasing as well. So the benefit of a participating policy is that the cash value increases exponentially. So what I mean by that is it's going to just start growing more and more and more and more over time. It's not increasing at a flat rate, like a steady 3%. It's going to be like 3, 3.5, 4, 4.5, 5, 5.5, 6.5. So it increases by more and more as time goes on. Okay. So there's also a premium reduction. So it can be used to pay back premiums, or to help you pay a premium. So say you have the $80 dividend, and that you say, you know what, I'm just going to give you $920 this year. Use that $80 to cover the difference in premium for me. Does that make sense? So instead of them giving you they can give you the cash, You can use it to buy 1 year of term insurance. You can use it to buy permanent life insurance. Or you can use it to reduce your premium. So takes money off the next premium. All right, so you say, I just push it. It's like PT, it's like paid time off almost, but for life insurance. It's like, I don't want to pay I don't want to pay 1,000. I'm going to give you 920, use my dividend to cover the rest. And then the next is accumulate at interest. 8 at interest. So the interest is taxable. What this means is you tell them, just hold on to it, and I want you to hold on to it and just keep letting it earn interest in your account. Okay, any questions about that? Okay. Now, a mutual company is a company owned by policyholders. It's actually a policy owner. I think they call them policy owners, not policy holders. Different types of insurance, they call it policy holder. Life insurance policy owner, right?
So I do have a question.
Yes,
Is dividend options able to be split? Like, can you do like a
I
premium?
can barely hear you, I'm sorry.
I'm sorry. Can you do like a premium reduction and like accumulated interest, or is it just you have to pick one?
There's something really going on with your microphone. Anybody else have an issue here? It's hard, okay. If you can type out the question into the chat, Shmari, that'd be really helpful. I can't hear what you're saying. I'm sorry. Something's up with the microphone. Okay. And okay, participating and not participating. Now, non-participating. Oh, I actually do have some questions in the chat here. Okay, my bad. I have my phone read it to me. Yeah, the email is right there. I'm gonna just put my email in the chat. I'm gonna have it in there. If you want to do interest accumulated and premium reduction, no, you can't. You just have to pick one. Dividend option. Non-participating means it doesn't participate in dividends. So essentially, you don't got to worry about any of this stuff. Okay, it's owned by stockholders who receive company profits. Okay. Okay. All right. Non-participating owned by stockholders who receive company profits. So let me just see here what else I'm missing for whole life. I know there's some stuff, so Oh, great. Make sure I got it all. Okay, so for cash value. Okay, cash value. In a whole life policy. It's a savings component. So essentially, it's a value. You can't call it savings account, but it's a value in the policy. It's like equity, right? So the policy is worth something over time. It's like if you're paying into a house, you start to have equity in the house over time. So there comes a point when the policy is worth something, it has value, and that's what's called cash value. So at that point, it's an asset that you can take money from. So you can take loans against the cash value. Every state has a maximum interest rate that they allow companies to charge when you take out a loan against the cash value. So say you had $5,000 in cash value, you need $1,000. You can call your insurance company and say, hey, I want to take a loan out on the cash value for $1,000. And then you'll get a loan for $1,000 against the cash value. Does that make sense? Any questions about that? The cash value increases over time. So it does, usually you don't have cash value until after 2 years of having the policy, unless it's a single premium or a limited pay, like right here where you have 10 pay or single premium, then cash value is usually more immediate. But the reason why is because typically in the first 2 years, the insurance companies are paying commissions and expenses and everything else. So they actually lose money in the first couple of years because of everyone they have to pay their staff, the underwriters to look at the policy, everything else. So it's usually the first 2 years they lose money. So the insured does not receive, the policy owner does not have any cash value in the first 2 years, typically for a regular whole life policy. Okay. Yeah. So all you gotta do is email me for this and I'll get it to you. It might take a day or two for me to get it to you guys, but I'll get it, okay? All right, so cash value, it's the savings component, grows over time. You can take loans out against the cash value. It increases over time. So as time goes on in your policy, you get more and more and more. We went over dividends. Cash value for ordinary whole life typically grows at a guaranteed rate. Cash value grows at a variable rate, depending on the stock market. Okay, now there are some things I'm going to cover called non-forfeiture options. Okay. So a non-forfeiture option is when you have equity in the policy and you have something of value. So it's like if you can sell your house, you can take money out of it in terms of a loan, right? Like a whatever they call that, home equity line of credit. So there's some non-forfeiture options, meaning if you stop paying your premiums, these allow the policyholders to receive something of value from the policy. Non-forfeiture means it can't be forfeited. Like there's something there that can't be forfeited. So they can take cash surrender value, which is the cash value minus any policy loans, right? You can purchase reduced paid up insurance. What this means is, say you have $10,000 in cash value, and you say, I don't want to make any more premium payments. I want to use that $10,000 in cash value to purchase a permanent whole life policy using a single premium insurance policy or a single premium funding method. So say you have $10,000 in cash value and you're like, I don't want to keep making my premium payments. How much permanent insurance can that $10,000 of cash value buy me? Does that make sense, guys? Anybody have a question about that? Okay, cool. So, and then that's reduced paid up insurance. And then you can also get extended term insurance. So extended term insurance is when you take. So that's what you do with extended term insurance. You take that same 10,000, say you have a $100,000 policy and you have $10,000 in cash value. Instead of taking the 10,000 and saying, how much permanent whole life can this $10,000 buy me? You say, how much term insurance, how long of a $100,000 term policy will this $10,000 buy me? So you take the face amount of the whole life policy. Say we have a $100,000 whole life. It has $10,000 in cash value. So do this 100K whole life, 10K in cash value. Okay. Extended term will uses the 10K of cash value to buy a $100,000 term life for however many years the 10K will buy it for. So maybe the 10,000 buys a $100,000 whole life for the next, 30 years or whatever. Something like that. You don't have to make any more premium payments on it. So those are the options that you can use with cash value. You can either take all the money that's available, cash out, that's it. It's only taxable if the amount that you take is more than what you've paid in. It's only a taxable event. Because then you have to declare a profit, right? Other than that, it's just premiums you're getting back, essentially. Reduced paid up insurance. I'm going to use that $10,000 in cash value to buy a permanent whole life policy for however much cash value, however much of a face amount that $10,000 in cash value will buy me. Or extended term insurance. You say, I'm going to use that $10,000 in cash value to buy a $100,000 term policy. Depending on how old I am when that happens, will determine how long that term policy lasts for. You guys clear on the non-forfeiture options? Does that make a little more sense? Okay, cool. All right. So some whole life and term policies offer a living benefit, which is known as a terminal illness accelerated benefit rider. Every company calls it something a little different. It's your state by state, they may call it something a little different. But what that means is if you're terminally ill and you have a life insurance policy, the company typically lets you access a piece of it, if not the whole thing, before you pass. That way you don't have to try to sell the policy to someone else in a viatical settlement, which you'll learn about it in another section. A viatical settlement is when someone sells their policy. So say they're like, hey, I have a $100,000 policy. Doctor said I'm going to die in 5 years. I'll sell it to you for $70,000 because I need the cash now. I can't wait. And the person says, all right, cool. I'll claim 100K when you die, or whatever the case is. It's kind of like, I don't know. It's like you're profiting off someone dying. It's like not that cool. It's kind of like, it's kind of messed up. So companies want to avoid that just from an ethical standpoint, and they want the client to be able to get their whole benefit. So they say, hey, we're going to let you get some of this money up front. Doctor writes a note saying you're going to die soon, next year or two, depending on what state they're in. They can access a piece, if not all, of the death benefit up front. Does that make sense? Any questions about that? All right. So I hope this helped you guys. If you guys want a copy of this, email we're on Zoom here. I'm just saying this for the people watching this on YouTube. Subscribe to the channel, turn on post notifications. If you want a copy of this document, just email me at jve@thejbe.com. My email will be in the description of the video, and you can put the subject as life insurance policy webinar notes, or life insurance policy notes, life insurance policy study guide, something like that. Just put it in there. I'll catch it, and I'll read it and just say, hey, I want a copy of the document that you went over in this video, and I'll give you guys that for free. And yeah, I hope this video helped you. Want to watch the next video coming up too. It's going to help you pass your exam on the first try.